contract builders, and economic aid. That's what the market has been saying about China's state-owned enterprises investing overseas. But the SOEs participating in the Belt and Road Initiative are trying to go beyond that with the help of private investors.
We have presence in 20 investment projects in Africa through shareholding and joint ventures. Most of them are contract constructions, but we are also jointly investing with all sorts of capital in industrial parks, logistics, real estate, mining, and agriculture.
That strategy would give those SOEs long-term profits overseas.
We want to shift from an industrial company to a commercial company. Construction projects only make 3 to 5 years of profits. We want to become developers and operators of the projects we build for local market shares.
Those SOEs' core strength is in construction. To expand their business portfolio, the less risky ways to work with private companies specialized in other areas.
As all these projects get underway, there will be multiple needs, especially on risk management, that insurance can play a role to help mitigate. Infrastructure construction will lead to entire supply chains moving from China into some of these overseas countries.
Some of those SOEs are willing to share some of the profits from the Belt and Road, and that's not a guarantee for private investors to come.
Institutions need to be developed in some of these countries along the Belt and Road, whether it's the rule of law or very clear government policies supporting these projects, or ways of mitigating risks for private capital. These are actions, considerations that must come into play now.
Public-private partnership has been touted as a good practice for large-scale industrial projects, but companies are still not sure whether the model fits the Belt and Road.
In reality, PPP hasn't been the most suitable model for infrastructure projects. Very few have succeeded. We don't have much experience in it either. That's why, going forward, we need deal advisors to help us analyze the financial model and risks for PPP projects.
It explains why Chinese SOEs are leaning towards private investment in the target markets, and they're now more keen to do so.
Many governments along the routes of Belt and Road actually do ask for localized teams to manage infrastructure projects. We are trying our best to follow that policy, as long as our projects can successfully land on the ground. This is for the long-term benefits for all.
There are currently $35 trillion of investable private capital in Asia alone, and $120 trillion globally. To attract those funds into infrastructure, especially in the Belt and Road, China must allow the market to open for all and keep the standard of investment high for its own players. Xiaocheng, CGTN, Beijing.